Hello, I'm Emma Wall, and joining me today to talk about markets and coronavirus is Johanna Kirkland from Schroders. Hi, Johanna.
Morning.
So, unlike some of the other fund managers we've been talking to in this series who focus on one asset class and one country, you have the whole world and mixed assets in order to find opportunities. But presumably that also means that you have the whole world and mixed assets to navigate, because there has been some pretty exciting and pretty difficult things that have happened. If we take first bonds, for example, which seem to be pricing in recession, ultra low growth for a very long time, there's negative interest rates. How have you invested through that turmoil?
Well, I think, in recent years, we've been positive on bonds. I think that it was popular to say that bonds looked expensive. But generally, even before we came into this crisis, we were concerned that global growth was very anemic, that we weren't getting the usual kind of recovery you would expect. And so against that backdrop, if you're more worried about growth than you are about inflation, actually bonds are still a very good hedge in the portfolio. So we generally have owned them and we've liked them. I guess, as you say, they rallied to extremely low levels of yield just recently. So we're talking about 0.6% on the US 10-year. And at these levels, we have lightened up some of our exposure. But all in all, again, we're more concerned even on a forward-looking basis about growth. And so it will continue to be a hedge in our portfolios. It's just that certainly compared to, say, 20 years ago, the luxury of being able to park yourself in bonds and earning a 5% yield has obviously gone completely. So it's a bit of a concern we don't have that cushion in the portfolio, but I still think it is an important hedge.
And where can you still find income in that asset class? Because you mentioned their developed market government bonds, which are incredibly low, but there's a broad range of asset classes within that fixed income super sector, isn't there?
Absolutely. And I think, again, because of the crisis, we got to a situation at the end of March where even fairly defensive areas like investment grade debt was looking very, very cheap. We saw spreads blowing out quite aggressively. And, some of the worst conditions for that particular asset class since the financial crisis. So we took advantage of that. I think that's the benefit of having a portfolio that can cast its net widely. You can take advantage quite nimbly of those opportunities when they arise. So we added back to investment grade debt quite aggressively, just, in the depths of the crisis. And it's been a good source of return and also still quite a defensive allocation in the portfolio. So, a good opportunity there. High yield debt is also interesting. High yield debt, of course, is more cyclically exposed, so we need to be a little bit careful. But again, yields rose very significantly in March, and we saw an opportunity to generate more income there. So government bonds look very expensive, but actually credit as an asset class is looking more interesting than it has done for a while because of the strains we saw in March.
And how cognizant of the economic backdrop do you have to be when choosing where to allocate in fixed interest? I'm thinking in particular globally. We're speaking here in the week that the UK has just put out some pretty scary looking figures for GDP growth in April. Globally, there is expected to be more of the same. Coronavirus has impacted growth. How does then that reflect where you're looking to invest?
It's absolutely essential. So, our starting point is to look at valuation. I always say, this is really, the fund I manage, the Managed Balance Fund, is really a one-stop solution. And I often say all we're trying to do is manage money the way most people would if they have the time and resources that we have. So it makes sense generally to try and buy assets when they're cheap and sell them when they're expensive. So you can start off with valuation. But you always have to look at valuation in the context of the economic environment you're in. And so I mentioned government bonds. To many people, they looked expensive in recent years, and actually they've kept on rallying because guess what? We're in a deflationary environment. So you always have to couch the valuations in the economic regime that you're in. And, even when we look at equities, for example, we've had an allocation to Alex Tedder, who's our head of global equities, and he has a bias towards growth. We've also allocated to his disruption fund, which is really focusing on trends like automation. These areas look quite expensive relative to other stocks in the market. But, the coronavirus in some sense has intensified some of the disruptive trends we're already seeing. And this is an area that's continued to do well before the crisis and after the crisis. So absolutely, the economic environment and long-term trends are very much what we're trying to capture in this portfolio.
Let's talk a little bit more about equities then. As you mentioned, where you're allocating, we obviously saw global markets move down quite sharply to the end of March, but have picked up again since then with a little bit of increased volatility in recent weeks. Which part of the market do you think is correct? Do you think actually bad news was too badly reflected in prices and sentiment drove things too low, but fundamentals were too strong? Or do you think we're in a position now where actually people aren't taking heed of the real risks that are out there? There is this sort of division when we come to equity markets of which equity market is right. Is it the end of March or is it the market now?
Well, I think, the way I put it at the end of March was that we'd reached the end of the beginning, to use a Churchillian quote. And what I meant by that was that by that point, we'd got to peak coronavirus pessimism in the sense that we were really dealing with the most extreme medical emergency that we'd seen for the virus. And I think that now, although the second wave infection is a real risk, ultimately we're all better positioned to cope with it. We understand it better, and obviously the medical services are in a better position to cope with whatever might happen. So that was the end of the beginning, and what really marked that was the flattening of the infection rate in Italy. So that gave us a sort of roadmap for how you get the virus under control. So that was a very important point. And then with the intervention by the governments, obviously that reduced some very extreme risks in the market. So that's really what's driven the market rally so far. And we've been saying we're in the second phase, which is about recovery, where the lockdowns are eased a bit. We moved from an acute environment to a more chronic problem with the virus. And so that did merit an adjustment in market valuations. I think as we make it through the summer, though, as we head into the autumn and people start to look to 2021, I think there again, people might have to reassess a little bit what the longer term consequences of this virus are, the implications for employment. I think, unfortunately, unemployment is here to stay. At the moment, it's being masked by some of the government schemes, but ultimately, people will be losing their jobs. This will have an impact on demand. And so we're more cautious further out. So we added back to risk at the end of March. We benefited a bit from that. We did it quite cautiously, but we did add a bit of risk back. And as I said, I think maybe as we head into later this year, we start to look into 2021, we might see some more caution coming back into the equity market.
Do you think that then drives a further divide between the types of sectors that, as you alluded to there, are disruptive, are tech heavy, are looking through to the future, impacted positively by demographics, robotics, etc., and the stuff that's been left behind? Because before coming into this crisis, people were looking at those kind of stretched valuations and that division and expecting things to come back together. But actually, it's just increased, hasn't it?
Yes, I think it has. I think that there's an opportunity. We've just seen in the last couple of weeks a bit of a bounce in value as a style. And I think that, that can continue through the summer as the lockdowns are eased. But bigger picture, I would say, I think that COVID-19 has intensified some of the trends that were in place. So automation being a perfect example of that. Also greater use of digital technology. All of this has been intensified by COVID-19. And I think some of those trends are here to stay. Interestingly, though, even in Alex Tedder's global equity portfolio, where he has had this growth bias, he has been taking advantage of disruption. After the crisis in March, he did start to see value in industrials, for example. So when you think about the value cohort, there are three main sectors that are in that area. Energy, and I think we're all aware of some of the headwinds facing the energy sector for the foreseeable future. Banks, again, we'll probably work out what the headwinds are facing banks. In a difficult economy, can banks really perform very strongly? Probably not. But industrials is an interesting area because actually this is an opportunity for stock pickers to find strong industrial companies that have the balance sheet to withstand the shock to demand and actually could benefit from some of the disruption that's created. So it's not just about growth versus value. Actually, funny enough, even Alex Tedder's found opportunities in areas like industrials, which would normally be considered a value part of the market.
And is that because those companies that are well established, who have been around for a long time, presumably they will turn to be at the forefront of innovation through M&A or through new innovative developments within their own companies? Because we have seen it in other industries as well, where actually you think the incumbent is going to be taken over, but actually they can change tack and indeed innovate themselves.
Yes, and I think also there's also disruption to supply chains. So, for example, because of this crisis, again, a trend, we're already seeing the pendulum swing away from globalization. Obviously with the moves that Trump was making against China in the last couple of years, people really revisiting that idea that globalization is a good idea. And again, I mean, what this COVID-19 crisis has highlighted is the importance of having resilient supply chains, which in some sense might mean people simplifying the supply chains or bringing more of their supply chains back home. Again, this can create opportunities in the industrial sector, but it's very much a stock pickers market, I would say.
And you say that, I know you focus a lot on making sure you get the right price for stuff. Asset prices have moved around quite a bit over the last 4 months. From an asset allocation point of view, where are you now compared to where you were, say, at the beginning of the year before both opportunities and headwinds presented themselves?
Well, the main change relative to the beginning of the year is that we increased our allocation to credit. So at the beginning of the year, the opportunities there, the spreads, as we call them, were wafer thin. There really wasn't very much to go for. That. A lot of the juice has been squeezed out because, of course, there's, with rates being so low, everyone's desperate for yield. And so, that's really been the area where we've increased our allocations. On equities, we were positive at the beginning of the year. We had we'd allocated to some of this more growth-oriented strategy with Alex Tedder. And then, as things darkened, we did bring down our weights a little bit and then added back. So we're sort of back to where we started on equities. I think the biggest change has been the increase in the allocation to credit at the expense of government bonds.
Johanna, thank you very much.
Thank you.